I think it's time we do a little update on Walgreens Boots Alliance. What do you think? Walgreens reported earnings last week, and since then, the stock is up 20%. So, were the earnings any good? Over the past month, the stock is up 26%, which would make you think that the turnaround is taking place. The CEO is changing things, and the company has probably good prospects now. However, if we zoom out to the past year to date, this paints a much different picture, which is the one of a struggling company. Walgreens Boots Alliance is down 59% year to date, which is probably one of the worst performing stocks in the entire US market. Now, if you're a dividend investor, this stock has probably been on your radar, in part due to this decrease in the stock price, but also because of this 9% dividend that just seems so juicy. The dividend was cut a few months ago, but even despite this cut, the dividend is probably one of the highest in the S&P 500 at the moment. Now, on this channel, I previously reviewed WBA in about February of this year, of 2024. And the title of this video was Avoiding Value Traps. At the time of releasing that video, the stock price of Walgreens Boots Alliance was around $21 per share, and the stock is down around 52% since I released that video. And if we look at the performance of the quality ratings that are released on Rated A, these get updated once every year once the company releases the annual report. WBA actually has had the worst quality rating possible since coming onto the platform. And so, in a celebratory moment, we now have the first sample of tracking the performance of our quality ratings. And pretty astonishingly, WBA lagged the MSCI World Index last year by 79%. But it's an intelligent thing to keep reviewing your thesis and your theories as the years go by. And for example, when a stock drops 50%, that's a significant drop. If you're a value investor, you know that whenever the price of a stock goes down, the expected future return goes up. So today we'll be looking at this stock. Is it a good investment at this price? Let's dive right into it. So what's going on at this company? The new CEO took the reins at the start of the year and brought in a fresh executive team to tackle the challenge of turning around the floundering pharmacy giant. Management's plan involves cost-cutting measures, starting with the closure of 1,200 stores out of 8,000 over 3 years, 500 of which will be closed in fiscal 2025. WBA will also prioritize paying down debt and strengthening the balance sheet, even if it means selling long-term equity investments and divesting VillageMD. If we look at WBA's sales for 2024, they're actually up from 139 billion last year to 147 billion this year. The problem is the gross margin. The gross margin is down another percent from 19 last year to 18% this year, but it follows a long-term trend of just losing and losing and losing. Have a look here. In 2013, Walgreens' gross margin was 29%. So clearly the company is having more and more trouble actually profiting from the sales that it makes. And that's mostly due to reimbursement rates. So the way Walgreens makes money on prescriptions is that there's an agreed rate at which whenever Walgreens sells a prescription drug, they'll get a percentage in return as a reimbursement fee. The problem is that this fee is calculated by pharmacy benefit managers, aka PBMs, and these PBMs have been consolidating over the past few years, and there's now 3 big ones in the United States. What they've done is, because of their bargaining power, they've managed to push these fees down for Walgreens. And so Walgreens is making less and less money with every prescription that it sells. So what management is deciding is that they'll close about 15% of total stores. But the stores that are closing supposedly will be the ones that are losing the most money. And so this will have the effect of increasing the gross margin and hopefully boosting the profitability in the near term. The second thing they mention is paying down debt. If we look on the Rated A metrics here, debt doesn't seem to be that big of an issue compared to the company's current assets. And the reason for that is that on Rated A's platform, debt only takes into account long-term debt, which is the traditional debt that these companies take from banks and then they have to pay back an interest over time. What it doesn't include is these operating lease obligations. As you can see, Walgreens only has around 8 billion of long-term debt, but 21 billion of operating lease obligations. Now, these obligations are not traditional in the sense that Walgreens has to pay interest on borrowed money, but there's still a financial obligation. Walgreens has contracts with landlords saying that they will pay rent at X location for 10, 20 years. And so the total amount of all these payments over time is added here under operating lease obligations. And while these obligations don't incur any interest, they are still obligations. Walgreens is committed to making these payments. And if they don't, well, the company could be in trouble. And so what the company is doing now is it's going to sell some of its equity method investments here, which it has started doing already from 3.4 last year to 2.2 billion. So this number is already coming down to pay down the debt. And the second thing it's considering is a complete divestment of VillageMD. But what's VillageMD and why is it important? VillageMD is a provider of primary care and urgent care services serving patients in a traditional clinic setting. So this is what it is. It's basically a medical center that's right next to a Walgreens retail store. Patients can go to the VillageMD, get their prescription done, get their appointment done, see the doctor, and then they'll take the prescription to Walgreens and collect their medications. And this is where things start to irk me a little bit because Walgreens invested in VillageMD and bought out a significant share in this company as recently as 2020. And since 2020, they've poured in $6.2 billion into acquiring this company. In the moat section of WBA's analysis, I wrote, in recent years, Walgreens has pushed into services like urgent care, home care, and specialty pharmacy in order to diversify away from the less reliable traditional pharmacy revenue stream. This initiative aims to make healthcare more accessible and establish WBA as a leader in local primary care. These services not only would have higher margins than WBA's pharmacy retail business, but they also generate additional prescription sales and increase foot traffic within stores. And most importantly, the intricate network of pharmacists, doctors, regulations, and copay structures involving governments and insurance providers would make it challenging for new online pharmacies to compete with WBA in these new categories. Because this is another big problem with Walgreens. Traditionally, convenience was Walgreens' superpower. Look at this. 80% of Americans live within 5 miles of a Walgreens-owned pharmacy. So Walgreens doesn't have the scale of a Walmart, of a Kroger's, of a Costco. The only reason Walgreens was able to make decent money from its retail business was that it was a very convenient place to go do groceries. And if you choose to go to the pharmacy next door to buy your bag of chips because you don't want to get in your car and drive 20 minutes to the nearest Walmart, well, usually people are willing to pay a bit more for that. And so Walgreens was able to keep prices a little bit higher than their competitors. But now Amazon is getting into pharmacy, and the convenience that Walgreens used to have by being, in close proximity to most people, well, now most people can order on Amazon and get it straight delivered to their houses. So in theory, VillageMD was a good idea from management's perspective, where now Walgreens was going to be a multi-healthcare company where everyone comes to get their appointments, see their doctors, get all their checks, get their prescriptions. And this would increase the moat and also probably the profitability because once you're there, you're likely to do some shopping there as well. But now management is pivoting once again, and granted, it's not the same management that made the idea to acquire VillageMD, 4 years ago. But still, this is clearly a company that's flip-flopping into and out of businesses, making acquisitions just to stay busy. They're so financially restrained now that they have to make these sales in order to pay down debt. So as a company, this is not a great place to be in. Because once again, here's the thing. Walgreens lost 1.7 billion in 2023 from VillageMD and these integrated healthcare projects. Last year, that jumped to 14 billion from all the investments that Walgreens is doing in opening these stores, etc. So this is not a cheap investment. Earlier I mentioned that WBA paid about 6 billion to acquire VillageMD. Well, from all the money that's being lost on these projects, it's unlikely that they'll regain most of that if they decide to divest. And this is already reflected in this year's financial statements. If we look at the goodwill line on the 10K, we can see that it went from 28 billion in 2023 to 15 billion. What happened there is that the management marked down their investment in VillageMD. This is basically them admitting that they overpaid in their investment and that their assets are not worth what they paid for. So, yeah, like this summary says, it seems like most of that capital went to waste. And so, this substantial loss in goodwill is reflected in the operating income. And so, we see that the margin takes a huge nosedive this year. This also affects the return metrics like the ROIC and the ROCE. The one silver lining here is that from now on, moving forwards, the asset base of the company has shrunk because of the decrease in goodwill. And so the return metrics, the ROIC and the ROCE, should improve moving forward. Last year, Walgreens also had to pay a large opioid related litigation fee. The company has accrued a total of $6.6 billion liability associated with the opioid related claims and litigation settlements. So, yeah, management is obviously saying that this is a one time expense, a one time fee. But if you look at Walgreens' risk factors, they say it themselves. We are exposed to risks related to litigation and other legal proceedings. So it's one of those things where management says, disregard it. It's a one time expense. It's not going to happen next year and the year after. Sure, this litigation specifically won't happen again in future years, but it's pretty likely that something else will come up again and again and again. After all, Walgreens is a pharmacy company and they sell molecules that have side effects and that go into people's body. And so if someone is trying to sue, due to these side effects, they can turn to the pharma companies. They can also turn to the pharmacist and to Walgreens. So there you have it. Despite WBA's efforts to turn itself around through cost cutting and debt reduction, the company's core issues persist. Its lack of differentiation, coupled with pressure from online competitors in pricing and convenience, continues to erode its moat. PBMs are still driving down drug reimbursement rates, and the debt obligations and interest payments are reducing the firm's maneuverability. This is something else to keep in mind if you're going to make an investment at these levels in WBA. Over the past 10 years, the interest coverage has continuously declined. In 2024, the company was paying half of its operating free cash flow, or the money that it makes from operations, into interest payments. So clearly, management's hands are tied behind their backs. They're even foregoing making investments into their own business in order to pay down debt. These are not the characteristics of a compounder. Now, guys, in investing, nothing is black or white. If you have a very high risk tolerance and you want to make some speculative plays, Walgreens Boots Alliance might be a stock for you. Because, yes, for the past 2 years, WBA has had negative free cash flows. And we all know that that's not sustainable forever. As of today's price, which is about $10, the shares are trading at 5 times the free cash flow of 2022 and 2.5 times the free cash flow of the 3 years before 2022. If Walgreens can bring back the free cash flow per share seen in 2022, I could easily see this stock doubling in the snap of a finger. If the company is able to bring free cash flow back to the level seen from 2019 to 2021, then this could be a 4x. So these are all things to keep in mind. The other thing I think is important is that for those of you that are considering buying the stock for the dividends, I would think twice about that. I say that only because it's been 2 full years now that WBA has had negative free cash flow. The only way to pay dividends when you have negative free cash flow is by going through the equity or taking on extra debt or issuing more shares. And the company is neither issuing more shares nor taking on debt. So what they're doing is they're going through their balance sheet and paying shareholders based on the assets that they have on there. Once again, that's not sustainable. So I could very much see this dividend being cut very soon. Just before closing off this video, I want to do a quick valuation exercise. Walgreens Boots Alliance is a F quality stock, which means that to buy and hold for the long term, I would just avoid these types of companies. This is why the value rating is so low and the income rating is also low despite the 9.5% dividend yield. But just for fun, like I said, if you're looking for a speculative play, this might be interesting. If we take today's share price of 10.5, the current revenue, we assume zero growth based on them closing down stores, a 2% margin, which is about average that they were able to do before 2023, no share buybacks, a terminal multiple of 10, which is historically what WBA was putting up when they were a healthy company. Let's say they cut the dividend entirely, so zero growth on that. That's still a 26% return over the next 5 years. But like I said, the risk with this one is very high because if we decrease the free cash flow margin from 2 to 1% in 5 years, then the returns go from 26% annual to 10% annual, which is the market rate. So again, I just like playing with this calculator because it shows me the risk and reward potential from investing in any stock. When it comes to myself, I'm not investing any of the company's money into WBA, even at these levels and even with this dividend yield. All right, guys, that's it for this video. Check out Rated A if you like these types of analysis and this perspective on investing. And I'll see you in the next one. Peace.